Welcome to The Deep Dive, the show that really equips you with the crucial insights to be truly well-informed. Today we're plunging into, well, a really fascinating but also challenging corner of the automotive world. We're talking Tata Motors, and more specifically, its luxury powerhouse, Jaguar Land Rover. JLR. It's a brand we all associate with heritage, luxury, performance, but it finds itself at a really critical crossroads right now. Can JLR pivot fast enough? Can it survive this storm of global headwinds and still keep that premium DNA intact?
That's exactly it. That's precisely our mission for this deep dive. We're basically distilling critical information from a whole stack of fresh reports. We've got HDFC Securities, ICICI Securities, Motilal Oswal, all of them hot off the press, following JLR's recent investor day. That was June 16th, 2025. So our goal today is simple. Extract the most important nuggets, the key insights from these analyses. We want to help you understand JLR's current challenges, yes, but also its strategic responses and, what the financial world is really saying about its road ahead.
Okay, so we're talking about a real luxury icon facing some pretty serious turbulence. Let's start with the big picture then. What's the immediate financial outlook for JLR, according to these reports?
Right, so the first really significant takeaway from that investor day is a definite revision in their financial expectations, for the near term anyway. JLR has actually lowered its EBIT margin guidance, that's earnings before interest and taxes, for fiscal year 2026, or FY26. The new range is 5-7%.
5 to 7%. And where were they before?
Well, exactly. To put that in perspective, they just reported 8.5% for FY25, and their previous target was considerably higher at 10%. So this isn't just a minor tweak, it's a pretty substantial downgrade to their profitability outlook.
Wow. Okay. And it's not just margins, is it? How does this shift impact their cash generation? I mean, that's crucial for future investment.
Right? Absolutely crucial. And yeah, that's where it gets perhaps even more impactful. JLR now expects its free cash flow for FY26 to be near zero.
Near zero, compared to what they just did.
Exactly. It's a stark contrast. ICICI Securities reported $1.5 billion in FY25. Motilal Oswal mentioned $1.8 billion. So projecting near zero free cash flow, that's not just a grim financial snapshot. It's kind of a red flag, isn't it? It tells us JLR faces a pretty critical liquidity squeeze that could significantly constrain their ability to fund all those ambitious future projects they're banking on. It really changes their investment capacity for the next year.
Okay, so those numbers definitely paint a more cautious picture. Beyond the figures, what exactly is causing this shift in confidence? What are the fundamental headwinds JLR is battling right now?
Well, there are several things going on, and they're kind of interconnected. First, there's significant tariff uncertainty. That's a big one. Now, JLR sounds optimistic about a potential U.S.-EU trade deal, and apparently a U.S.-UK agreement is expected by the end of this quarter. That could reduce tariffs from, 27.5% down to 10%. For up to 100,000 units.
Okay, that sounds promising, but...
But yeah, the catch is tariffs on certain vehicles, like the ones produced in Slovakia, think the popular Defender SUV, those remain contingent on that broader EU deal actually happening. So still some uncertainty there.
And these tariffs aren't just theoretical worries, right? They already had a tangible, real-world impact on their operations, haven't they?
Oh, absolutely. Motilal Oswal actually highlighted that JLR had to temporarily stop shipping cars to the U.S. back in April 2025. Why? Because of a sudden hike in these tariffs. It just shows you a crucial vulnerability, doesn't it? How quickly trade policy changes can disrupt supply chains, force immediate, costly decisions. It's likely going to hurt their performance in the first quarter of FY26. And JLR is now actively, redirecting supply to markets that are easier to access. And they're looking at pricing actions in the U.S. to try and soften the blow. Then second, you've got the China market. It continues to be really challenging. The sources we looked at describe it as a situation of, quote, limited demand facing unlimited production capacity.
Oof, that doesn't sound good.
No, we're seeing rising discounts there. And a significant number of passenger vehicle dealerships have actually closed down. HDFC Securities noted 4,400 closures in calendar year 2024. They say that's about 15% of total dealerships. Motilal Oswal uses the same number, 4,400, but highlights it represents maybe half, about 50% of the total dealer network. So a huge impact.
Wow, half.
Yeah, it's a bit unclear on the exact percentage, but the number 4,400 is consistent. Either way, it's a lot. And to make matters worse, the premium market in China actually declined by 15% year over year in FY25. Plus, new credit issued by banks, that fell 21% year over year in CY24. That directly hits people's ability to finance vehicle purchases.
Okay, that paints a really tough picture for what's usually a massive market for luxury cars.
Yeah,
Are there other major macro trends or sort of operational hurdles adding to this already difficult situation?
Yeah, there are. We're also seeing uncertainty around the global BEV transition, battery electric vehicles. Demand just hasn't quite taken off globally as maybe some expected. Now, on one hand, that gives JLR a bit more time, perhaps, but it also reflects a wider market hesitancy, doesn't it? Then there are rising costs. Their capital expenditure is elevated. JLR expects to invest $3.8 billion total between FY24 and FY28.
18 billion. Where's that money going?
While over half is earmarked for engineering, the rest is going into things like battery and electric drive unit EDU facilities and tooling, big investments needed for the future.
And they're also facing issues like rising warranty costs and currency fluctuations, too. It really sounds like a perfect storm of financial pressures.
It kind of does, yeah. JLR saw warranty costs go up in FY25, and the US dollar weakening against the British pound, that's a long-term risk to their margins, although they are hedged for the near term, apparently. Oh, and another fascinating detail, maybe a bit concerning, is this technical protectionism risk with ADS systems, advanced driver assistance systems.
Technical protectionism. How does that work?
Well, the US and China are getting increasingly worried about data privacy. And what that means is global car makers, OEMs like JLR, they're essentially being required to develop separate ADAS technologies for different regions, which basically leads to, double engineering costs.
Ouch. Double engineering costs.
Wow.
Wow. Okay, it sounds like they are truly navigating a perfect storm here. So, given all these massive challenges, how is JLR planning to steer through it? What's the counter strategy?
Right, and that's the crucial question, isn't it? How does a company like this adapt to such a dynamic environment? JLR has announced what they're calling enterprise missions. These are aimed at driving transformation, obviously, and offsetting these headwinds we've been talking about. The goal is ambitious. Deliver $1.4 billion per year in benefits. That's starting from the second half of FY26 through FY27-28.
$1.4 billion a year. That's a serious target.
It is, and this is ultimately designed to help them get back to that earlier target of a 10% EBIT margin over time. They've even reiterated a long-term goal of 15%. So they're aiming high despite the current pressures.
Okay, enterprise missions sounds quite grand. What are some of the key types of initiatives these missions actually focus on? What are they doing?
They're broadly categorized. First, you've got urgent impact measures. These are about directly tackling the immediate issues like tariffs, emission compliance, reducing those warranty costs. For instance, they're apparently leveraging AI and predictive analytics to improve forecasting and reduce customer downtime. Smart stuff.
Makes sense. What else?
Second, there are high-value initiatives. These focus more on deep cost efficiencies. They have a target for a double-digit reduction in structural costs in FY26. That's significant. They're also looking at improving manufacturing and freight costs and boosting performance in China.
How are they planning to improve things in China, given how tough you said it was?
Good question. They're talking about prioritizing the higher price segments, optimizing their retail network there, and launching the Freelander model through their joint venture with Chery. That's planned for the second half of FY26 to sort of expand their market reach. Third category, unlocking potential. This is about enhancing brand positioning for all future products, including their upcoming BEVs, and also increasing accessory sales. That's often a pretty high margin area for car companies.
Right, the add-ons. And finally, you mentioned what they're calling game-changing initiative. How do those fit into the overall strategy? What makes them game-changing?
Exactly. These seem to be more long-term, maybe more transformational. Things like creating even stronger brands after the BEV launches really get going. Leveraging digital initiatives to optimize the total cost of ownership for customers, making it easier, cheaper to own a JLR vehicle over its lifetime, and significantly improving customer loyalty, which is key in the luxury market.
And are they seeing any results from these loyalty efforts yet?
Apparently so. They reported a global net promoter score, or NPS, of 94. That's pretty high. Also, a 12% global reduction in customers who have open issues or complaints, and a 3% reduction in order cancellations. So those are positive signs on customer satisfaction, definitely.
Interesting. Now, given the global rush to electrification we see everywhere else, you might expect JLR to be, flooring it with their BEV launches. But you mentioned earlier they're actually taking a unique, maybe more patient approach. Can you tell me more about that?
That's right, they are. JLR clearly indicated they will not rush to market with BEV launches just for the sake of it. The current slowdown in global BEV demand, which we talked about as a headwind, is sort of paradoxically giving them time time to develop what they're calling the best versions of their BEV products, focusing on quality and brand fit, perhaps.
Quality over speed, maybe.
Perhaps. And what's particularly interesting here is they've noted strong interest for their future BEVs is coming from non-JLR customers, people who don't currently own one. So that could potentially expand their market quite significantly beyond their traditional buyer base.
Okay, so with all these challenges, the revised outlook, one might expect the brand itself, the image, to be hurting a bit. But what's really fascinating reading through these reports is that they actually highlight pockets of really remarkable resilience, real strength within their individual brand, right?
Absolutely. It's a powerful counter-narrative, isn't it? Despite all the broader economic headwinds, their key brands show, well, significant strength. Let's run through them. First, Range Rover. Its brand equity score is an impressive 101. It's even entered Interbrand's top 100 global brands list now.
That's huge.
It is. And order intake for the main Range Rover model increased 15% in FY25, Range Rover Sport, up 34%.
Yeah.
And they've had a huge success with these ultra-exclusive special editions, like the Born of the Sand edition at $400,000, or the 10 Years of SV edition in China that went for $615,000, and the Masara edition in India, $680,000.
Wow. People are paying that.
Apparently so. And get this. The Range Rover Electric, which isn't even out yet, already has a wait list of over 60,000 units.
60,000. Okay, what about Defender?
Defender's doing great, too. Its brand equity improved to 82. It actually posted record-high sales in FY25, even though the current model is in its 6th year. That's quite something. Order intake rose 3%, and they say that was with minimal marketing spend. And that limited edition Defender Octa, priced at £165,000, it already has an order book of 3,000 units. Shows its positioning is really moving up market.
Okay, Defender's strong. What about Discovery?
Discovery's brand equity is stable at 74. Order intake only declined 5%, which is pretty good considering the weak market demand overall. And here's a fun fact the reports mentioned. 30% of Discovery clients are female, and over 50% own pets.
Pets. That is a fascinating demographic quirk, isn't it?
Right.
Maybe future models need bespoke pet washing stations, like you joked. Okay, and what about Jaguar? That's their more traditional sports car luxury sedan brand, right? How's that faring?
Indeed. And Jaguar, well, with its new Type 00 reveal, it seems to have generated significant buzz, particularly on social media. This new product, this new direction for Jaguar is specifically expected to attract younger customers. That's a crucial shift, really, from the relatively older demographic they had with the previous ICE variants, the petrol cars. And in the U.S., awareness for Jaguar as a luxury brand increased by 23%. And 20% more customers now apparently see it as a brand worth paying more for. So that suggests a successful repositioning effort might be underway.
That's definitely a powerful foundation to build on, especially with those iconic brands performing so well in places. Now, given the complexity of modern cars, EVs, autonomous tech, all that, are they leaning into partnerships? Are they collaborating to manage costs and get access to technology?
Yes, absolutely. JLR seems to believe strongly that partnerships are crucial for navigating these disruptive trends and, frankly, managing the huge costs involved. They've partnered with NVIDIA, for example, for autonomous driving tech and AI. The aim is to have NVIDIA-based software capabilities in their next-gen vehicles. They've also teamed up with Dow and Adient. That's for industry-first initiative using recycled materials in car seats, a key sustainability move.
Good to hear. What about batteries? That's a huge piece of the EV puzzle.
Right. Their EV battery plant in the UK that's being done in partnership with Agratas, another Tata company. It's set to be operational by 2027. And they've also partnered with Tata Communications for global connectivity in their next-generation vehicles. So yeah, these are all very strategic alliances designed to bolster their capabilities across the board.
Okay, so let's try and bring this all together. We have a company facing some pretty significant hurdles, tariffs, China costs, the EV transition, but they're actively implementing these ambitious enterprise missions, these strategies, and we're seeing pockets of really strong brand performance, especially with Range Rover and Defender. Given these mixed signals, how are the financial analysts actually interpreting all of this? Are they optimistic? Pessimistic?
Well, this is where it gets really interesting because we see some clear divergence in their views. It's not unanimous at all. HDFC Securities, for instance, they maintain a reduced rating. Their target price is INR 681. They're expressing significant caution on the JLR segment, especially in the near term.
Okay, so HDFC is cautious. What about the others?
ICICI Securities, however, they maintain an ADD rating. Their target price is higher, INR 775. They seem to believe Tata Motors is, and I quote, well-positioned to navigate near-term challenges. So a more positive take.
Right. And Motilal Oswal,
Motilal Oswal reiterates a neutral rating, target price INR 690. So sort of in the middle. They emphasize the, quote, multiple headwinds that they believe mar the outlook. They see the challenges clearly.
Reduce, add, neutral. That's quite a spread in ratings, isn't it? It's a classic example of different perspectives on the same set of facts. Given those starkly different analyst takes, what do you think is the core divergence? Where are they disagreeing? Is it short-term versus long-term?
I think that's likely a big part of it, yeah. HDFC seems more focused on and perhaps worried by the immediate impact. The lowered guidance, the tariff mess, the China struggles. Seeing those is a significant drag right now. ICICI, on the other hand, they probably place more weight on the long-term stuff. Those enterprise missions, the undeniable strength of Range Rover and Defender, that patient BEV strategy, they likely view those as factors that will eventually allow JLR to, navigate through the current turbulence and come out stronger. And Motilal Oswal, well, they seem to be sitting on the fence a bit, acknowledging both the strong fundamentals and the significant, undeniable headwinds that make the path forward pretty challenging, really.
Right. Well, this deep dive has certainly shown us that JLR, Tata Motors' luxury arm, is navigating a truly complex, pretty volatile global automotive landscape right now. From grappling with unexpected tariffs, that really challenging China market, adapting to the evolving BEV transition, and those rising operational costs, they've clearly got their work cut out for them.
Absolutely. But what's also clear is their strategic response. Those enterprise missions, they're ambitious, they're comprehensive, they're aiming to save substantial costs and get back to higher profitability. And despite all those headwinds, you just can't ignore the strong performance and the exciting developments in their core brands. Range Rover, Defender, even the buzz around the new Jaguar direction. Plus, those key strategic partnerships, they highlight areas of significant resilience and, future potential that shouldn't be overlooked.
So wrapping this up, what does this all mean for you, the well-informed learner tuning in? What's the final takeaway here?
Well, consider this thought. JLR's decision not to rush its BEV launches, using the time, as they say, to develop the best versions. Now, that directly contrasts with many competitors who are following really aggressive, maybe rushed EV timelines. So could this more patient, quality-focused approach, combined with the proven, almost bulletproof strength of their existing luxury brands, and that clear strategy to attract new, younger customers, could that actually give JLR a unique advantage? An advantage in winning long-term customer loyalty and maybe, crucially, profitability as the electric vehicle market truly matures over the coming years. It's definitely a compelling thought, I think, for the future of luxury automotives.